When we talk about accounting, we usually highlight the balance sheet, and the balance sheet is the statement that tells you at a given point in time what are the resources and obligations of a particular business. So it tells you from the left hand side the assets, the resources owned and controlled by the entity, cash, receivables, investments, inventory, machinery, plant, property, and equipment, and even intangibles. The right-hand side tells you the combination of borrowings or debt, either short-term accounts payable or banks payable, long-term nature like corporate bonds, and equity, own shareholders' funds, either common shares or preferred shares, preferred stock, and other equity items, and retained earnings or accumulated profits. So when you look at the balance sheet, it is a snapshot picture of where the company is at its at any point of its life. The left hand side tells you the uses of funds, whereas the right hand side tells you the sources of funds. So when you're asked, when you're analyzing a business and you're being asked, is the company growing? Now, normally you would look at the assets and whether the assets are growing year on year. But the right approach is to focus on the sources of funds. Are they able to consistently expand and grow their sources of funds? Technically, asset is equals to liability plus equity. When we analyze, you look at the sources of funds to understand whether a company is growing. Company is growing, but their growth is fueled by borrowings. That could be problematic in the long run because we're exposing the company to higher solvency issues or leverage risk or financial leverage risk. We can then look at the uses of funds when we're asked how efficient is the company in terms of deploying their resources. So when you're asked about growth, look at the sources of funds. When we're asked about efficiency of use of operations and assets, look at the uses of funds.